Ladies and gentlemen, federal employees, today we're talking about the already scheduled, the already on the calendar increase to your taxes and what you can do now to get ahead of it. That's what we're going to dive into today. And if you're new here, so good to have you. My name is Dallin Hodge. I'm a financial planner and CFP who works with federal employees every day to help you guys get the most out of your benefits and retire confident. And let's dive right in. So today we're talking about what they call the TCJA, or the Tax Cut and Job Act. Long story short, this happened back in 2017 where taxes were decreased, which was great. We love decreased taxes. However, they came with an expiration date where they were set to last until the end of 2025. So that early 2026 or starting 2026, they're going to revert back to what they were before. However, this could be stopped if Congress did jump in and make a change. However, if they did nothing, taxes would revert back to what they were pre-2017, which means in general, if someone was a lower-ish earner, it was probably an $800, $900 decrease they saw to their taxes back in 2017. If they're mid earner, we're talking, a few $1,000s, right? And it really depends on how much money you make, but the more money you make, the more of a difference this sort of thing would make. So long story short, taxes are going up. And in my opinion, I don't think Congress is going to stop it. I think in general, the government needs their money, right? As we see with all the, let's say, debt ceiling issues we've seen over the years, whatever, they need as much tax revenue as they can. I would be very surprised if tax rates stayed as low as they are. And even if in 2026, maybe they pushed out the date, whatever it is, over time, if I was a betting man, taxes are going up. It's just a matter of when and by how much. Now, based on that, what can you do? Is there anything you as an individual can do to get ahead of this so that you save as much taxes as you possibly legally can? And the answer is yes, 100%. If we know that tax rates are going up for you in the future, well, the way to get ahead of that now is to save money in the Roth TSP. And the reason is, if you don't know already, is that when you put money in the traditional TSP, you get a tax deduction today, but when you pull it out later in retirement, you have to pay taxes then. So if tax rates are higher then, you're going to pay more taxes over time, and you're going to be paying it in retirement, which retirement is not a fun time to pay high taxes. It's a painful time to pay high taxes, right? So if you put money into the Roth TSP now, that means you're going to be paying the taxes now, which if tax rates are going up in the future, now's the time to pay it, right? Now, I get a lot of pushback from some people saying, hey, look, I don't want to pay the taxes now. I want to pay it later. And that's fine. You knock yourself out if you want to do it, right? However, think about it. Think about it. When I talk to people that are close to retirement, let's say within 3 years, they're often they are scrambling to get debt paid off. They want to pay for their kids' college. They want to get that out of the way. They want to pay for that big wedding. They want to get all these big expenses out of the way before they retire, because there's something that just feels comfortable. While you're working, there's a security that comes with getting things paid off while you're working, right? While you're working. So one of the biggest expenses you're going to have in retirement is taxes. If you're able to knock some of that out now by using the Roth TSP, it's an incredible feeling to go into retirement knowing you've paid a lot of those and you've got a huge amount of money in the Roth TSP that's growing tax-free for the rest of your life. That's an incredible thing to have. Now, the Roth TSP does not make sense for everyone. I get it. I've got other videos that actually talk about exactly when you should be using it and when you shouldn't. But think about it. I think most people, the majority of people, should be using the Roth TSP, okay? They should. The majority should. Not everybody. I didn't say everybody, right? But the majority of people should, to get ahead of these sort of things. And even if tax rate, let's say, don't go up, the majority of federal employees, at least that I've worked with, they tend to not drop into a much lower tax bracket at all in retirement. Often they're in the same tax bracket in retirement. So keep that in mind. If you're able to knock some of it out now, you're going to give yourself so much more freedom, so much more wiggle room, psychologically, certainly, and financially down the road. Now, one big advantage of the Roth TSP as well is Roth money is not subject to RMDs later. RMDs, if you don't know, starts around 73 to 75, depending on your birthday. And basically what an RMD is, a required minimum distribution, that's what they're called, is the government forces you to take money out of normal retirement accounts like a traditional TSP, traditional IRA. The government forces you to start taking money out because they want their tax money before you die, right? They want it as you go along, starting in your early 70s. However, if the money is in the Roth TSP, Roth IRA, etc., then that money can grow over time tax-free and it's not subject to RMDs. So there's a lot of advantages. Think about it. Again, I'm not saying it makes sense for everybody, but it certainly makes sense for everyone to at least think about it. So hopefully that helps. Again, taxes, in my estimation, my best guesses, they're going to go up, just a matter of when and how. But there's a few things like staying into the Roth TSP that you can do now to get ahead of it. So I hope that's helpful. Have an incredible rest of your day. I'll see you guys next time.